So we'll go through both of those and give you a good background. So a stock insurance company, like it sounds, is one that is owned by the stockholders. So it is a corporation that is owned by the stockholders or shareholders, and it's typically publicly traded on some sort of exchange or stock market. So these firms are like your Progressives, your Liberty Mutuals, your MetLifes, etc. Larger names, everyday names you've heard of. These stock companies are best known for what we consider commodity-based insurance products. These are going to be your home, your auto insurance, your property and casualty insurance. Now, the main objective of a stock-held life insurance company is going to be returning profit back to the stockholders. So if I'm the company here, my goal is to return profit, not so much to the people in here that are what we call policyholders or customers of the stock insurance company, but more those who own stock in the company and the performance of the company. So their objective is to return that profit down to the stockholders and not necessarily the policyholders. So in other words, if I have a policy with Progressive, let's say, I do not have a vested interest in the company itself. Basically, I'm just a customer, right? I use their insurance product. Therefore, as a policyholder, I'm not really their priority in terms of the company's eyes. The priority really belongs to the stockholders, these guys down here. And returning profits back to them is their number one priority. So outside shareholders can be stockholders in an insurance company, just like any other publicly traded company, your Googles, Apples, anybody else on a stock index. So some of the largest insurers in the US are all going to be your stock insurance companies. So on the other hand, we have what are called mutual insurance companies. Now these are going to be a little bit different. The best analogy I've seen to use to explain these are they operate like a credit union does. So basically they have the ability to be much more flexible, and they actually are owned universally by the policyholders, which are you and I who actually own policies with the brand. So flexibility and return of premiums of interest that we're going to talk about here in a second all goes to us as the policyholders. So like a credit union, these are a group of like-minded people who are able to pool their resources around a common goal or service, and in this case is able to issue policies in a very specific way so we can design them with the unique savings goals in mind that we want to try to achieve with our leveraged wealth accounts. So these mutual companies are able to distribute and control the organization because they do not answer to stockholders like we do over here. They are owned by us as policyholders. And because we're owned by policyholders, we are able to really have this contractual credit arrangement that means that all reserves, surpluses, dividends are all held in the benefit of us as policyholders. So unlike a stock company where profits bypass the policyholder, they're actually going to go right to us as the policyholder. So if I have an agreement with Penn Mutual, with Guardian, with New York Life, any of these mutual-oriented life insurance companies, like a credit union, I'm going to be able to actually get any profits are going to be dispersed to me in the form of dividends and interest. So these surpluses, like we talked about, if we talk about interest, these mutual companies actually guarantee a minimum interest rate. Now typically it's 4%, and this is a floor, which means it's the bottom that they're going to provide, or a minimum, and it will go up from there. So the interest component is actually guaranteed, and the dividend, or the return of profits or performance, remember, if I'm a stock company, those profits go right to the stockholders, just like a publicly traded company. In a mutual company, they're not listed, they're not stock held, they're actually going to be returned to us as policyholders, and we're going to get that in the form of dividends. Now these dividends are never guaranteed. However, the companies that we work with are actually going to be very, very strong sources of growth, and they have been returning solid dividends for well over 100 years. So the interest is guaranteed at a minimum of 4%, and the dividends that we're going to spit out, while not guaranteed, there's a very, very high likelihood there's going to be some form of dividend in addition to that 4%. Could be 1, a half a percent, could be 2%, depends on the performance of the company, the year, and what's going on there. Now, the management team of a mutual insurance company has the ability to adjust and make a decision on what that dividend rate is going to be because it's not guaranteed. With that said, our qualified mutual companies are, it's worth noting that they have consistently provided those dividends for over 100 years. So mutual companies are typically best for the policies that we're talking about because we are looking for long-term savings growth. And we're looking for accounts that are going to maximize that cash value and they're going to minimize premium costs. The companies that we utilize at Leverage Life Management are very flexible and specialize in achieving this concept of privatized banking and leveraging policies as savings vehicles. So at the end of the day, mutual companies are who we want to focus on. And we do have a whole list of those on our website if you want to check those out to see the type of companies we work with. We are appointed with all of them, and when we sit down and do consultations with our clients, we do actually set up the best policy with the best company based on your specific need.